Are you constantly on the wrong side of the market? When you go long in an uptrend and then it suddenly reverses on you? Or when you're in a short trade and right at that moment, the market turns again? Well, that ends today because we can spot reversal patterns through divergences. You can time the very bottom and catch insane moves just like this. Make sure to stick around because by the end of the video, you're going to be spotting market mood swings like a pro. In order to trade divergences correctly, we have to first understand what they are. A divergence occurs when a price of an asset and an indicator, such as an oscillator, move in different directions. Identifying divergences can help you make more informed trading decisions and catch trend changes before they happen. There are two main types of divergences: regular and hidden divergence. With regular bullish divergence, price makes a lower low, while the oscillator makes a higher low. Bullish divergence are used to confirm possible trend reversals on an important support level. For normal bearish divergence, it would be the opposite, with our price hitting a higher high while our oscillator hits a lower high. Divergence on price are usually tracked by the candle bodies, but the wicks can still work as well. Now for hidden bullish divergence. This is when price makes a higher low, while your oscillator makes a lower low. Now with hidden bearish divergence, we would look for price to make a lower high, but our oscillator to make a higher high. Hidden divergences are used to confirm a possible trend continuation when prices retrace to a certain level. This is the difference between regular and hidden divergences. With regular divergence, we're looking for potential trend reversal. With hidden divergence, we're looking for trend continuation. In order to spot these divergences, you'll need to use an oscillator. There are many that you can use. These include RSI, MACD, and the stochastic oscillator. Honestly, you can use any oscillator to identify divergence. It doesn't matter which one. Now that we've covered the basics, let's look at a chart and a live example. For this example, we're going to be using RSI as our tool to identify divergence. This can be enabled from the Indicators tab by simply typing in RSI and selecting the first one that comes up. Before we start, we're going to change the style of the RSI because we only want to focus on the divergence, so we'll want to remove all of the noise and anything that's not needed. So if you double click on your RSI indicator, you'll open up the settings. Now change the color from purple to a more neutral color like white. This will help you visually keep track. I personally like to make the line a little bit thicker. Now disable RSI based moving average and the Bollinger Bands. You'll also want to disable the RSI background and RSI bands. So in this example, we can notice that price is locally in an uptrend, and you can see this from the higher highs and higher lows being painted. However, as you can see here, price is having a hard time going higher. We see lots of rejections. This is signaling to us a resistance level. Then we see price breaking through the highs, but immediately closing below with a bearish engulfing candlestick. If we take a look at the RSI and compare it with the chart, you'll notice that the market has made a higher high, but RSI has failed to do so. This signals to us bearish divergence, which can indicate a potential reversal of the trend. We can enter a short position after the bearish engulf. We can place our stops above the high, and we can target our levels lower. Now we're going to cover hidden divergence. In this example, the market is trending up. It's a bullish market, so we should be looking for long opportunities. If we want to get in the trend, we're going to look for hidden bullish divergence. So if you look closely, price has created a higher low. But if we take a look at our RSI, we can clearly see that it's made a significant lower low. This shows us a hidden bullish divergence, and it means that a potential continuation of the trend is likely. So we can get in after we see the bullish engulfing close and ride this trend to maximize our profits. This brings us to the end of the divergence video. I really hope that I've explained this for you in a way you can understand. If you know a trader that might benefit from this video, please share it. Make sure to smash the like button and subscribe. And check out some of the other free educational content on our channel. Make sure to leave a comment on what you want to see a video on next.